All right, today we're going to tackle a puzzle from the world of finance that, honestly, seems to defy all logic. It's all about what I like to call the bond market's great seesaw. So let's just dive right in.
And here it is, the big question. Why on earth do the prices of bonds you already own fall when interest rates go up? I mean, your gut probably tells you that higher rates should make things more valuable, right? But nope, not with bonds. It's the total opposite. And by the end of this, you're going to get exactly why.
So to really get to the bottom of this, we've got to start by understanding this counterintuitive relationship. It's a fundamental principle of investing. And trust me, once you get this, the whole bond market is going to make a heck of a lot more sense. You know, the easiest way to think about this is like a seesaw. Picture it. On one seat, you've got interest rates, and on the other, you've got the price of bonds that are already out there. So what happens? When market interest rates climb, brand new bonds are coming out with these really attractive higher payouts. All of a sudden, that older bond you're holding, with its lower fixed rate, it doesn't look so hot anymore. So to even have a chance of competing, its price has to drop. It's really just basic supply and demand. And look, this isn't just some abstract theory. It's a core mechanic of how the market works. Investopedia lays it out pretty clearly. When one goes up, the other goes down, and vice versa. It's just a fundamental rule of the game. Okay, so to really crack this puzzle wide open, we have to get super clear on the two things that make this seesaw tick: price and yield. These two are mathematically tied together, and that link, well, that's the key to the whole thing. First up, price. Pretty straightforward, right? This is just what you pay to get the bond. It could be its face value, let's say $1,000 if you're buying it fresh from the issuer. But, and this is key, if you buy it from another investor on the open market, you'll pay the market price, which, yeah, that can be a totally different number. And now for the other side of that coin, yield. Simply put, this is your return on investment. The formula is actually pretty simple. Your current yield is just the annual interest payment divided by the current price you paid. But here, and this is absolutely crucial, that annual interest payment is fixed. It is set in stone. It doesn't change. So think about that formula. If the price on the bottom goes down, what has to happen to the yield? It has to go up. It's just pure, simple math. All right, enough with the theory. Let's see how this actually works with a super simple example. We're going to use something called a zero coupon bond. This is great because it cuts out all the extra noise and just lets us see the mechanics in action. Seriously, get ready for the aha moment. So a zero coupon bond is perfect for this because it's just so darn simple. It doesn't have any of those regular interest payments, those coupons. You buy it at a discount, hold it, and then at the very end, at maturity, you get paid the full face value. Your entire profit is just that difference between what you paid and what you get back. Okay, so let's imagine you're the investor. You buy a 1-year bond. It promises to pay you $1,000 when it matures in a year. But you don't pay the full grand today. No, you get it at a discount. You pay $950. The math here is easy, right? You make a $50 profit on your $950 investment. That gives you a return, a yield of 5.26%. But of course, the market never stands still. Imagine, like the very next day, interest rates across the board just spike. Suddenly, brand new bonds are being issued that offer a juicy 10% yield. Now think about your bond. If you wanted to sell it, would anyone even want it? I mean, why would anyone buy your 5.26% bond when they can just go get 10% on a new one? The short answer? They wouldn't. Not unless you're willing to make them a better deal. To make your bond competitive, you have no choice but to lower its price. And it's not just any price. The price would have to drop all the way down to about $909. Now, why that exact number? Because at that price, the profit someone else would make gives them a 10% yield, which perfectly matches the new bonds on the market. See? The price had to fall so the yield could rise. Okay, let's flip this whole thing around. Let's hit the other side of the seesaw. What if, instead, interest rates suddenly drop? Let's say down to 3%. Now all the new bonds are only paying out that lower rate. How's your original bond looking now with its guaranteed 5.26% return? It looks amazing. Suddenly, you're holding the hottest ticket in town. Everybody wants your bond because its return is way better than anything new they can get. And what happens when there's high demand?
the price gets pushed up. Buyers would happily pay you up to, say, $970.87 because even at that higher price, the yield they would get still matches the new 3% market rate. Your bond's price went up because market rates went down. There's the seesaw.
So that's how the mechanics work on a single bond. Now, let's zoom out and look at the bigger picture. Who's the main driver moving these interest rates around? Well, here in the US, that's the Federal Reserve, or the Fed. Yeah, whenever you hear on the news that the Fed did something, they're almost always talking about the federal funds rate. Now, this is technically the rate banks charge each other for overnight loans, but you can think of it as the foundation. It's the benchmark that influences pretty much every other interest rate in the entire economy. And that, of course, includes the rates on new bonds.
And this is where it all comes full circle. When the Fed raises rates, guess what? New bonds offer higher yields. That makes all the old bonds out there less attractive, and so their prices fall. And when the Fed lowers rates, new bonds come out with lower yields, which makes those older, higher-rate bonds look really good, and demand pushes their prices up. It's the exact same seesaw we just talked about, but now it's playing out on a massive national scale.
Okay, so we've covered a lot. What are the big things you really need to walk away with? Let's boil it all down to the key takeaways.
First, and this is the big one, most bonds pay a fixed interest rate. That number does not change. So, second point, if market rates rise, the fixed rate on your bond suddenly looks less attractive, and its price has to fall to stay competitive. And third, the flip side, if market rates fall, your bond's higher fixed rate becomes a superstar, and its price gets pushed up by demand. And that right there, that is why bond prices and interest rates move in opposite directions. It's the whole shebang.
So, I'll just leave you with this question. The next time you see a headline flash across your screen about the Fed changing interest rates, you'll know exactly what's happening behind the scenes to the value of literally trillions of dollars in bonds all over the world. That seesaw is always in motion. So, knowing this, how does that change the way you see the market?